This is the Friday, May 6th, 2016 version of the Market Plus segment. Joining us now is Ted Seifried. Ted, welcome back.
Thanks for having me, Mike.
Well, we are always glad to see you. And on the program, we were discussing meat demand.
Right.
Beef versus pork.
Right.
And you were talking about the differences in elasticities, how consumers respond to price levels.
Right.
Can you expand on that a little bit?
Well, so like you were saying, elastic or inelastic versus prices. If demand increases when price goes down, that's inelastic. Or I'm sorry, that's elastic. Inelastic means it's going to be stagnant one way or the other, okay? For the most part, historically, beef demand has been somewhat inelastic. In good times during the stock market, in bad times, we're still going to McDonald's and getting our quarter pounders with cheese. Beef demand, everybody wants to eat beef. That's the country we live in. God bless America. That being said, pork demand is a bit more elastic. When you have lower pork prices, you have some more demand there. And when prices are high, we lose some of that demand. But in particular, pork demand is very sensitive to the relationship to beef prices. And if beef prices are coming down and pork prices are still relatively high, I think we're poaching some of that pork demand, both domestically and possibly abroad as well. So what I was saying at the end of the show is that I worry that if beef prices come down, which I don't think is going to happen in the near term, but in the long term, if beef prices come down, then I get a little concerned about that pork demand here, at least domestically, possibly abroad.
Sure, because people stand at the meat case and they go, well, I was just going to get some chops, but look how cheap ribeyes are.
Right, or as I was saying in the break, you go in for a porterhouse and then you see how cheap, pork chops are, and you're like, ooh, those look good. But if that gap narrows and that spread, comes closer in, then you're just going with the porterhouse.
It's easier to rationalize the porterhouse.
Come on,
or the
we live in
ribeye.
America.
Exactly. All right, so that's where we
Americans.
could see this trouble in the lean hog market if these prices maybe don't break along with the beef prices.
It doesn't really work the other way, as we were talking about. So if beef prices were going higher, and pork prices were staying low, you see some of that demand shift, but you still have a very, pretty standard demand for beef. It does go the other way, though. I mean, if beef prices are coming down and pork prices are still, relatively speaking, high, I think we start poaching some of that pork demand away.
All right. Now, we do have a couple of great questions from our followers on Twitter and Facebook, but I wanted to talk to you first since we are now on in North Carolina, and we really appreciate that. We didn't discuss cotton on the program. We saw cotton break $1.85 or so this week. Where do you see us going from here?
Yeah, sorry, North Carolina. I love you, but you look at exports. We're at 88% of what the USDA's target is, which is already a low target, in my opinion. So we're at 88% of the USDA's target. Last year, we were at 97%. 5-year average, we're a little over 100%, meaning we should have all of this marketing year's cotton sold and waiting to be shipped at this point. The fact that demand is just not there, and the concerns that we have with the dollar maybe finding a near-term bottom and starting to rebound here at this point, that dollar gets higher again, then we even have a harder time with cotton exports. So cotton has had a hard time, just like the wheat market. I mean, there's a lot of similarities between the cotton and the wheat market. We're trying to find a place where we can build that global demand, and the U.S. dollar is giving us a very hard time doing that because, relatively speaking, we do not have the currency advantage compared to any other cotton or wheat producer in the world, for that matter. So we're trying to find levels where we can stimulate that demand. For a moment there, we thought we might have sort of found it, but now it's just not, and especially with the dollar bouncing back up, we saw a poor performance on export sales, a little bit better than the week before, but still not a good number. I don't know what price point that is where we find that global demand. A lot of that will depend on if the dollar can come down.
Okay.
But unfortunately, you look at unemployment today, while it was mixed, but unemployment staying the same, has at least half the camp saying we're going to see a rate hike in July.
Okay.
Others will point to, okay, job creation wasn't as high, so maybe we don't see that, but at least you've got that discussion. And any possibility of a rate hike, which would mean higher dollar, has the cotton market under a little bit of pressure right now.
Okay. All right. Well, now let's get to some of these questions. Rodney in Edgar, Wisconsin is wondering, have we seen the highs for the grain markets for 2016?
Wow. Well, Rodney, you go back the last couple of years, and the highs in the grain markets for the marketing year came in the spring. So there's a very good chance that that could be the case again this year. That always depends on weather. And last year, the reason we had highs in the spring is because we got a lot of rain and we flooded out some acres, and we responded to that. At the end of the day, though, we ended up with an almost record corn yield and a record soybean yield. We're not seeing that same scenario now, at least not in most areas. There are some areas out west that are still getting hit with rain. It's really going to depend on what this growing season looks like. If we get hot and dry June, July, August, well, then no, absolutely, we have not seen the highs in the market. And there are some weather forecasts and weather forecasters that would suggest that we are going to have just that scenario.
With that scenario in mind, are you in the camp of making some physical sales today, re-owning with calls? I mean, how are you hedging against that?
Okay, that's a great question, Mike. I appreciate that because our mantra has been since December. We've been going out and telling everybody we can about this with every forum that we can. Our mantra this year, which is very different than anything we've done in the last few years, we are using cash sales to manage risk this year. We are using the board, whether it be futures or options, to manage opportunity. So, well before this rally happened, and really kind of gearing us up for this rally, we had been owning some calls on the idea that if we got a rally and we got anywhere near break even, hopefully above, we would start selling. We laid off a lot of new crop soybean sales on this move. We continue to do that. But we've owned calls, and we've owned the 980 November calls on this whole run up. So we're in the money on our calls at this point, which makes it very easy to make those cash sales because we're not worried about whether we're missing out on opportunity. That opportunity is still going to be on the table for us.
For those that haven't been making a lot of new crop sales, and let's talk soybeans, how do you handle that today? Do you still sell the physical and spend the money on a call?
I don't think you do it. I don't think you spend the money on the call here.
Okay.
I think very likely we get enough of a break at some point. Maybe we're not making new lows. Honestly, I don't think until we know what sort of crop we have that we can make new lows. But, if we get a 60 to 80 cent break at some point, which I think is likely, that's when you maybe go in and re-own the calls if you didn't own them previously. We were, again, stressing the idea of owning 40 to 60% of your production on those calls before we went into this rally, and that's worked out very well for our clients. But for that other 40 to 60%, we're looking for a pullback to add to that. But we have been making a lot of cash sales, more so in soybeans and corn. Corn never really got to the price where we could say, hey, we're well above break even. That all would depend on what sort of yields we're going to get. And with the weather forecasts that we've got out there, it makes you a little worried about what we're going to get to.
Yeah.
But we did recommend guys get to about 20 to 25% corn sales. But we've got guys on soybean sales anywhere from 40 to 80% at this point.
Okay.
Especially for the guys that, we were buying calls in January and February when they were really cheap because we had no vol, and we talked about that a lot in the last couple months. And that's worked out really well. I mean, we've got above break even, but yet we still have upside potential at this point.
All right. Now we've got a question here from Hedge Whisperer, Mr. Ellis on Twitter. At Celis 1994 is wondering, we touched on this with cotton, he's saying the dollar has driven the spring rally. If it corrects upwards, does that leave the rally dead? And let's look at soybeans. We've seen that Brazilian real, U.S. dollar battle really benefit U.S. producers. How big of a jump do we need to get to outprice our South American counterparts?
Well, first of all, Steve, how you doing? He's got a date circled on his calendar, and that is May 10th, which is this coming Tuesday. And he thinks that is going to be when we see the highs in the market. And the way it's turning out, he might not be wrong about that. Maybe we saw it a little earlier than that. But generally speaking, what he's been talking about there has made a lot of sense.
Okay.
And if that dollar does rebound from here, a couple of things. Yes, I think that the recent uptick that we've seen in new crop soybean sales might get a little bit hurt by that because we had been behind just like we were a year ago. But we've been playing catch up here recently. So that would get hurt by that, and that would maybe affect a little bit of the balance sheet, not necessarily on this May 10th report, but maybe going forward.
Okay.
The bigger question I have is, meal. Argentina has been somewhat reluctant, and a lot of that has to do with the major rains that they've had there, and that's slowed down their logistics, and it's really hurt their crop. So Argentina hasn't been as aggressive of a meal exporter as we thought they would be, and that's a big part of the reason why we've had this rally in soybeans in the first place, because it's been meal driven, we slowed down the crush in the anticipation that we were going to have a lot of competition.
Right. Because Argentina cut their tax to zero, export tax on meal and oil.
Yeah, so we were worried that we were going to lose out on global business on the meal market, and we were worried that we would even be seeing multiple meal shipments coming into the eastern seaboard from Argentina. We really haven't seen that. So, what, as it turns out, we sort of prematurely slowed down the crush, and now we have that demand stayed constant for soybean meal. And that's why we've had this sharp spike in meal, and beans have followed. So what does that do for meal going forward? And I guess it can't make it it can't slow it down anymore if our dollar gets better. Maybe that does bring them into the mix a bit more. So that
brings Argentina in.
Yeah, I mean, if our dollar is getting stronger, maybe there's if our dollar gets stronger and we get past the weather that we're having in Argentina and things sort of stabilize down there, do they start ramping up on their meal production as they take more of a global share of that meal market? That would have a big impact on our soybean trade, because our beans, in my opinion, are very much driven by the tightness in the soybean meal that we've seen, and soybean meal has been the leader. So if you take that away from soybean meal, or if you take the strength in soybean meal away from soybeans,
you're kicking the legs out from under the chair.
I have a hard time, justifying why we're up here.
And that leads Phil in Ontario, Canada, at Agridome sent us this on Twitter, and it's basically, what's the real reason soybean prices have defied their fundamentals? Because when you look at the balance sheets, we've got piles of beans sitting everywhere.
445 million bushels, according to the USDA.
But we didn't have piles of meal.
We didn't have piles of meal. And Phil, how you doing, Phil? Thanks for the question. That's a great question.
Yeah.
Again, I've been going on shows for about a month and a half saying that, hey, this crush has slowed down. Argentina is not picking up the slack there. Meal has reason to possibly go higher. And that's what's happened. I really do believe that meal has been the driving factor, and the fact that the crush did slow off those record paces is why we've had this rally. I think we've proved two things. I think we've proved that we need to keep the crush at or above the record pace that we've set last year to keep feeding that demand, because when we have low price meal, that demand is, well, going back to inelastic and elastic, that demand has grown very much with these lower prices. And two, we can all say that, a couple months ago, it seemed very likely that Argentina, with the currency and alleviating those taxes, was going to come in and be a dominant player on the world market as far as meal is concerned. But I think we kind of underestimated our domestic market here as well. So don't do that. Now, that being said, going forward, we are in a different situation than the last time we had this sort of meal-led rally from a tightness in the meal market. And that was a couple of years ago when we, for all intents and purposes, ran out of soybeans at a 92 million bushel carryover for soybeans.
Post-2012 drought.
No, actually, that was after 2013. We didn't catch up with acreage quite yet. So that was 2 years ago. I mean, that obviously was the case too, but that we were trading much, much higher prices at that point. The main reason why soybeans haven't had the decline that corn has had is, one, because we were trying to shed some corn acres, which we have, and two, because soybean meal demand stayed strong. And when we, again, 2 years ago, when we had a 92 million bushel carryover in soybeans, the crush dropped to near 10-year lows. And then very quickly, meal stocks got as tight as they could be. That rubber band was stretched as tight as could be. And then, boom, you had meal just kind of explode for $1. Meal explode, beans responded with a $1.80 rally. Not too unsimilar to what we've seen this time around.
Right.
The similarity ends there, however, because we have the beans to crush. More particularly, the crushers have the beans to crush. So this rally that we've just seen for these crushers have done two great things. We've increased crush margins dramatically, and they already have ownership of the soybeans. So that's even exacerbating that increase in crush margins. So it's a matter of time between when this crush really picks up and when the soybean meal stocks are hitting the market. But I don't think it will take that much longer than from where we are at now. And then it's all going to lie on what happens with the dollar, because yes, the dollar's come off the highs, but I don't think that justifies the big rally that we have had in beans thus far. The idea of inflation, yes, gold and silver have picked off and picked up off their lows, but I don't, again, think that justifies this entire rally that we've had in soybeans.
You bet.
And then, the weather issues in South America, which, like it or not, I mean, as we get into harvest and so on and so forth, that will come to an end. They'll
get the beans out.
They will get
Yep.
the beans out. Now, there will be some losses. We already know that. But at some point, we move past that, and I think we're getting close to doing that. So
All right. Take advantage of this rally.
take advantage of this rally. I'm not saying it's done yet necessarily,
Right.
because the tightness in the meal market could linger for a little while, because there is a lag between when the decision is made to increase the crush and when those meal stocks start to build again. But it's not going to be a multi-month thing at this point.
Right.
At the very most, it's probably a multi-week thing at this
And when
point.
the market gives you money, Ted, take the money.
Take the money. Yeah,
right.
profit margin. Listen, I mean, a couple weeks ago or a couple months ago, we were all talking about how we weren't going to make any money farming this year. So given the opportunity to have positive profit margins, we need to be taking some sort of action on that. We need to be taking that opportunity. And this has been, to some extent, a bit of a gift.
Yeah.
So let's do something about that. Again, more so in soybeans than in corn.
Yep.
But we got to do something about that. And there are ways of replacing that opportunity, because that's what everybody's so reluctant to give up.
I don't want to sell 1050 beans or 950
If we're
beans
going to
cash
12.
if we're going to 12. But
I get
that's
it.
why we have the futures and the options available. It's a risk management tool. And with that, we're going to have to wrap it up. Ted Seifried, thanks so much for joining me this week.
Always a pleasure, Mike.
It is. It is always a joy. And thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so, and we will get expert analysis right to you. Thanks for watching, and have a great week.